Well, if you're here, welcome, and congratulations. You just survived the worst week in markets since the COVID dump. Yes, it is a sea of red out there. There's tons of volatility. People are nervous. But if you're in crypto, you're faring far better than the rest of the market. However, if you happen to be a billionaire, things aren't quite as rosy this week. Is Bitcoin transitioning to a safe haven asset like we saw 2 years ago during the banking crisis in March of 23? Join me as we talk about the macro backdrop and explore the end-of-week charts for swing trading stocks, commodities, and crypto. This one is not to be missed. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Well, welcome back to the Trading Apologist. My name is Tom, and thank you for joining me for this end-of-week volatile weekly wrap-up. I mean, what a week to start broadcasting. After a big video on Monday, I really wanted to keep today shorter, just focusing on an end-of-week look at the charts and then get into some trading tools and setups. But there is so much to discuss on the macro. So if you're not too interested in the macro, I'm turning into a real YouTuber. I figured out how to break out the chapters below. So if you want to skip ahead, everything should be segmented and you can just get right into the charting analysis. Also, thank you for the great feedback on Monday's video. I am going to include Solana today and a couple new assets. I can't believe how many of you guys watched the entire hour. I thought the drop-off would be at like the 3-minute mark, but no, the majority of you endured all the way through. That means a lot, and it shows me that there's actually interest in the content, so that's encouraging. Thank you. If you have questions moving forward, please put those down below, and I'm going to try to continue to address those. And I feel so dirty saying this, but if you could hit the like and subscribe, that would help me start to get this out there to more people, because I'm brand new at this and I don't want to just be talking into the void. And heck, it might benefit you too by YouTube recommending similar content. Anyway, let's move on. Okay, just starting briefly on the Forex factory calendar. The main things today, of course, were the non-farms employment change, and that came in very positive at 228K versus the forecast 137K. That takes some pressure off the Fed for their dual mandate of employment and low inflation. And Fed Chair Powell spoke right after that, and we'll get into a summary of his comments later. But the main thing this week was those tariffs. Oh, those pesky tariffs on Wednesday. So the market was hoping for a blanket 10% tariff or a more targeted surgical approach. But what we got instead was wide swings, with some of the highest tariffs being imposed on Southeast Asian countries, which averaged out to 29% across the board. The way each country's tariff was calculated was imports into the US minus exports to that country divided by those imports. So Wednesday, going into the announcement, the market actually rallied. And then as soon as the tariffs were presented, we saw that sharp drop that continued through Thursday and into Friday. I would have hoped for more of a bounce on Friday. The last 30 minutes of trading, the S&P and NASDQ really tried to rally, but then they sold off heavily again in the last 15 minutes into the close. But we'll get into that when we look at the charts. So for those of you living in the US, I just want to give a quick explanation of tariffs so we can understand them and how the administration is intending for them to function in the market. Now, this isn't a political statement by any means. I just want to give us all a baseline understanding so we can make more informed trading and investing decisions. So basically, it would be a shift from an income-based tax to a consumption-based tax. And what you saw right after the tariff announcement was a tax cut announcement intended to go in tandem with the tariffs. So your income taxes would be cut, and the tariffs on all foreign goods coming into the country would then become that consumption tax. So the more you purchase, the more you consume, the higher tax you are paying, and revenue is then going to the government. So the other thing tariffs are intended to do is to encourage onshoring, bringing more manufacturing from global businesses to the US, creating jobs here. Now, yes, there is a lot of manufacturing that already happens in the US, but I worry about this plan just thinking from the perspective of a CEO of Business X. If you are currently producing in Vietnam, that's a poignant example because Nike got some relief on that today. But say there wasn't the relief and you're Nike and you're producing in Vietnam, you have 500,000 workers there. Now you're thinking of bringing your manufacturing to the US, spending billions on building out facilities. You're going to have higher input costs of labor when all that could potentially change under a future administration. and there isn't the infrastructure around that manufacturing of all the inputs of the materials that would also need to be built out in the US. So it's very complicated. On paper, it seems like a good idea, but I think it's one of those things that would take years and years to implement effectively and would have to have more of a permanent plan as opposed to the way that this set of tariffs was implemented. So just to give us all a quick overview of what was announced, there was a 10% baseline tariff on all imports, reciprocal tariffs on specific countries. So that was that calculus I presented earlier, why some countries got higher than that 10% for their trade deficit. The closure of the de minimis loophole. So this is an $800 duty-free exemption for low-value packages. This was just imposed on China and Hong Kong. So it's for e-commerce companies that are sending low-value goods into the US and not paying any import duties on those. The auto tariffs were confirmed. The national emergency declaration, this is the big one. The justification that Trump is using to impose these tariffs is the International Emergency Economic Act power, the IEEPA, declaring that the U.S. trade deficit of over $1.2 trillion in 2024 is a national emergency. So this justifying these measures to protect economic and national security. That's the thing that I don't know if it's going to hold. Now, exemptions and flexibility, this is already implying in part to Canada and Mexico to retain certain exemptions for USMCA compliant goods. And there was also an encouragement made to other nations to negotiate with the US. And we're already seeing some of that come through with Vietnam, the UK today on Friday, and other nations. So there's much uncertainty out there, hence the volatility we saw in markets. The key questions are moving forward. Will we reach trade deals, say, with the US's top 50 trading partners? And will the justification for these tariff actions even stand constitutionally? I have a feeling it's going to be tried in court before too long. Now, this volatility and uncertainty is why I changed my stance at the end of last year from more of an investing-based position. And when I say investing, for me, it's not 5-10 years plus, just putting it in the market and letting it ride. I mean, I bought positions a couple of years ago at the lows, and I let those ride up. But now getting into third-year bull markets, those are usually marked by more chop, just the market being up, down, and all around. And especially with a new administration, we know from Trump 1.0 that a volatile president can lead to volatile markets, and we're seeing that play out now. And the other thing I'm going to advocate for, and while there are a lot of opportunities out there and it's tempting to go in hard at these dips, which isn't necessarily a bad strategy, just please don't implement too much leverage. I mean, we saw many of the Mag 7 stocks take over a 20% drop the last 2 days. Imagine if you're in a 3 times leverage fund. I mean, you would have just gotten hammered. So be careful out there. Capital preservation is one of the most important things in investing. So this brings us to Powell. There was a lot of pressure on him to cut rates today, but we didn't quite see that from him this morning. Let's go over the key points of what he covered today. Now, he did acknowledge that tariffs are bigger than expected and the risk is higher. There's more uncertainty in the market. So it's too soon for the Fed to determine an appropriate policy path. He said the Fed was well positioned to wait for greater clarity. The job numbers take at least half of our concern off the table. And then that tariffs could have a persistent inflation impact. I don't necessarily agree with this one. Tariffs generally, if they are implemented, have an impact the first year of 3 to 5%, but then they're baked into the equation. So you wouldn't see that year-on-year increase. You would see a month-on-month increase, but not a year-on-year increase. And then the economic impacts of tariff are larger than expected. Yes, at 29%. We must ensure that price hikes don't lead to ongoing inflation. Yes, that dual mandate of steady employment and keeping inflation in check. We did, thankfully, have oil prices drop this week. That should help, at least with the inflation component of things. So with all that as our backdrop, let's look at some of the positives. As I mentioned in Monday's video, liquidity has spiked globally. We've seen a $4.6 trillion increase in liquidity since January 20th, and that generally takes about 12 weeks to trickle into markets. We're coming into that time frame within the next couple of weeks. The Fed could cut rates. Oil dropping this week is going to lead to lower month-on-month inflation. Employment numbers were good. So their dual mandate box is checked, and they could start easing. The 10-year yield is dropping. That's going to make the cost of borrowing for businesses and you and me, everyday average consumers, lower. So that's going to bring liquidity in. And with the snap of a finger, this tariff drama could all be behind us. The reason I'm optimistic, even though things have been so wild out there, is that this isn't a systemic fundamental problem. This isn't a real estate crisis. This is something imposed and brought on by the administration. I think we should take them seriously, but it is something that could be reverted with a policy change, with deals being made with certain nations. So I think right now the market is overreacting. It will still have an impact, but I'm hopeful that it won't be as severe as people are thinking it will be based on the last 2 days of trading. And you know, some of you might say I'm too optimistic, so balance this content out with someone that's more bearish out there. But retail investors were also buying the dip hard over the last couple of days. And crypto was steady for the entire week. And I think that's a real sign of strength and divergence in the crypto space. I mean, crypto led the drop down. Now it's holding the lows and actually showing a lot of strength comparatively. And the big one for me, and this isn't going to be a space for me to talk about altcoins much, just because they are so risky and I want to focus this channel more on swing trading. But altcoins were holding the line, and they have traditionally gotten pummeled in times like this. So I think that's very important to pay attention to. And could this be a leading indicator? I mean, heck, the Magnificent Seven were acting more like altcoins this week. Look at this chart. This is just for Thursday, showing how much value was erased from each of these companies. Now, if we are going to see the market recover, it really needs to be a tech-led rally. Money needs to start flowing back into the Magnificent Seven and broader tech in general, because they are such a big part of these indices. So until we can see that turnaround, I don't think the markets are going to recover in a meaningful way. Let's see what happens next week. Okay, let's dive into the charts. Starting here with the SPX, you can see that this just absolutely got hammered. We had a 9.1% drop on the week. If we take that from peak to trough, we're at 17.5%. And we broke through that 5,400 support that on Thursday I was really confident would potentially hold, but overnight China introduced reciprocal tariffs. There's just so much uncertainty out there that this continued to sell off. We actually went past the August lows. The next support below this is right around that $5,000 point range, from 4,950 to 5,050. Anything beyond that would definitely be a concern for me on the SPX, and I'm hoping we see a recovery and a quick V-shaped bounce next week. That's really what we would need to see here. Interestingly enough, the NASDQ, though it had a similar pattern, it was selling off heavier on this whole way down here, even into Thursday. But then the drop was less today, and it found support at those August lows. The thing I'm gathering from this, since the NASDQ is so tech heavy, that perhaps the selling in tech is starting to slow while other sectors are still selling off more. Looking to the DXY, we had a huge drop on that on Thursday as well, and a bit of a bounce up and attempted recovery today. But you can see those old levels of support are now becoming resistance. And my thought on the DXY, in accordance with Trump 1.0, they tried to weaken the dollar, and I would not be surprised to see it continue to go down like that. So let's move on to the semiconductors and SMH, the semiconductor ETF. The broader sector just got absolutely hammered, breaking this range that we've been in for 290 days. That is a big breakdown on the semis. If we go to NVDA, it is faring a bit better. I was thinking we might see some support come in here around that $100 level. We broke through this support range, and now we're testing the lows. This is kind of the last line in the sand. You can see we have good volume here around 90, but anything below that, I mean, next level is around $75 right here. So if it breaks below that, things aren't looking good for NVIDIA. The demand for semis is still high, but so much of this is manufactured overseas and imported into the US, even though some deals were reached with TSMC and a few others to exempt them from these import tariffs. There's so much uncertainty, and you're seeing that play out in these charts. Moving on to gold, let's just go to the daily. Now, gold, our upside potential target is still 3,600, maybe 3,400 in the near term. We did reject with the rest of the market. And now that old resistance at 3,000 is, at least in the short term, playing support. So keep your eye on that. The thing I will say on gold, if we look at the longer trends, retail is in the gold trade now. I see so many people talking about it. And gold goes through these long periods of consolidation. If you go way back on the chart, you can see it had a bit of a lost decade. But if you didn't get in for the last couple of years of this run, now the risk is so much higher, because by the time retail starts getting in, usually 2/3 of the move are done by the time retail enters. So you can still play this, watch that 3,000 support, and just know that the upside is limited, and be ready to get out if you see those topping signs. Silver, on the other hand, we were at this resistance, a bit of a double top. I don't like calling double tops, because by the time you know it's a double top, you're confirmed at way lower prices. But we did see a hard rejection. I mean, in the 2 days alone, what a flogging, down 14% almost in 2 days for an asset that generally doesn't move by more than 1% or so a day. But yeah, silver got absolutely smashed. We are kind of into a key range of support here. If we were to draw this out with just a little rectangle, I would say this entire zone here could be strong support. So from that $26 all the way up to 29. Again, silver, I think if gold rallies, we could see upside to 45, but what a drop. We really need to do some recovery on silver. Moving over to oil. Now, again, I'm covering commodities a lot, but I think it gives us a picture of the broader market. Oil rejected and broke down. Let me just go to the daily. So there was this little swing top here. I didn't think this would provide the amount of resistance it did. I really thought we would test this trend line, but oil rejected hard into the support zone. It did find a little bit of support bounce there, closing back in the zone. Now, for inflation, these lower prices are good because it means the input costs are coming down. But just watch these lower levels. I said on Monday that the range of around $60 is where oil is no longer profitable to pump, but someone checked me on that, and there's actually a bit of nuance on that if you're interested. Let's just dive in real quick. So the average of where oil is unprofitable to produce is actually in that $50 to $55 range globally, but there's a big variance there. The OPEC countries, they can produce oil for as little as $25 to $27 a barrel. If you're looking at an area like Canada, Canadian oil generally ranges from $57 to $75 a barrel. In the US, less productive areas can be in the $60 to $70 range a barrel. And if you're looking for offshore projects in Brazil or Norway, they are generally between $37 and $43 a barrel. But let's just say that mid $50 to low $60 range is generally where it starts becoming unprofitable to drill. So we're thankful for the lower input costs, but usually that means that some kind of deal will be struck and these charts should turn around. Again, I'm not swing trading it, but one to watch if you're interested. Moving over to Tesla. I am still pleasantly surprised by the strength in these charts. Despite this weekly close, we're kind of right in this support range here, marked out in yellow. Now, we had the worst car delivery numbers in quite some time, but the stock still rallied into the tariff announcement. Now, that might be due to a couple tailwinds. The energy numbers were really strong that were released this week. And then also the talk of Elon stepping back from his Doge responsibilities really helped with this midweek rally. But you see, we're still finding resistance at the 200 MA, and we're finding support at this 240 to 250 zone. Now, it has held up really well comparatively to the Mag 7. Granted, it had this big drop already, but where everybody else saw this bounce and a huge pullback, Tesla is holding up really strong. Now, I still think we're in a bit of a trading range between this like $240 to $300 zone, let's say right here. We really need to get above that $300 to $310 before I think we have a sustainable chance of seeing higher highs. But the tailwinds are still good. I'm surprised it didn't move at all this afternoon. There was an announcement of FSD being released in beta mode to select users. So that is coming, but we just have to keep watching this one. If we drop back down into this range, I'm still personally in accumulation mode, building a position. But I also know that there's a chance that if the news are bad, we could still go down to this range around 180 to intersect this trend line at some point. Again, I'm hoping for a turnaround and a bounce before there, but my trading plan is ready for that possibility. Let's move on to Bitcoin and crypto. Let's just look at this at the daily and compare it to the S&P 500. If we look at that on the daily, at a period where we had this huge breakdown, and then we go back to Bitcoin. This is what I'm talking about with this relative strength and this support area around 81.5 to 81.8 holding is really quite impressive. We'll just zoom in a little bit. Okay, so on the daily, we have that underside RSI support that's being respected. We have this support kicking in here. We still have this downtrending trend line. So in the next few days, I would say up to the 15th of April is really going to be a decision point. Is this support down here going to hold, or are we going to break this trend line? The mean reversion, I would say, is looking good. We're nowhere close to peaking on mean reversion. The RSI is right in the middle of the range, so respecting daily uptrending support. So it's looking good for me on the daily. But again, be patient, react, don't predict. We want to see this downtrend break that goes all the way back to the highs of January 20th. On the weekly time frame, just a couple things to watch here. Let me just make the RSI a little bigger. I think this one's really interesting. During this entire bull market, we've had this RSI support at, let's just call it 44.4, 44.38. And it has held every bounce during this bull market since the start of 2023. Now we bounced away from that again 2 weeks ago when we made our lows, and we are holding that bounce. Ignore these trend lines. These are just for the daily. But holding this 44.38 on the weekly RSI, I would say is really important. The other thing I'll just bring up real quick, I don't use stochastic RSI much, but there is one fun thing on the weekly that you can look at on Bitcoin. And let me resize some of this. Okay, so looking at Bitcoin on the weekly with things resized a little better, just brought up stochastic RSI. You'll see that every 6 months or so, you see a cross where the blue goes above the red, and we go into these rally modes. And this might not look like much here, but that took us from 15,000 up to almost 25,000 right there in that rally. And then we consolidated a bit, and then when we got into the lows again, we had this cross. This was our next rally from 25,000. We had this little dip in the middle bit. Okay, let's just say 25,000 to almost 50,000. And then it dipped back down, and that cross and that next rally took us from that $40,000 level all the way up to 73. So now we dropped down, and we were in this long consolidation range last year. We had a couple fake outs here. And again, this is a very long-term signal, but generally like every 6 months or so, this will cross, right? And then we made those lows, and we rallied up to our all-time high, and now we drop back down. And the blue line just crossed above again. So this could be a leading indicator that Bitcoin is getting ready to run and make its next move up. Again, stochastic RSI on this big a time frame, a bit speculative, but we've seen that momentum shift in the past, and it could happen. But we also had this consolidation range where it crossed and chopped around a lot. But a fun one to keep your eye on. Moving on to Solana. This is a messy chart. I'm sorry for all the lines, but Solana is one of my key assets that I perp trade a lot. So I just have a ton of levels marked out. If this is too much of an eye chart for you, let me know. And in next week's video, I can just make another instance of this that is cleaned up a little bit. So the good thing on Solana, again, just looking on the daily, if I was taking this chart in isolation, and I would see that we're back to major support. So that's a good thing, right? Around that $110 range that has held for quite some time, that this zone used to be resistance. But when I see these two peaks and this massive breakdown, I would say there is weakness in this chart if I was ignoring the fundamentals. And normally I would say just let the chart lead, but there is so much happening that is positive for Solana right now in the background. We have record month-on-month numbers 4 months in a row for revenue, for users. The app ecosystem is flourishing. I mean, look at some of these numbers just from the apps built on top of Solana. So I think we're going to see that come through in the chart, and the fundamentals will win out eventually. We do have a big double bottom in play here. You'll see the daily RSI did break down from support, but the mean reversion is still quite low compared to our peak. So what I'm watching on Solana here, we had this downtrending resistance in yellow that ended up becoming support. We formed a double bottom. There's another downtrending resistance you could draw here. So I would like to see us break above this. I have another little support line back here, but that one we can ignore. Break above this and then take off from there. Again, we have a key level to break at 150. Getting above that would be the first hurdle, and then the 180 range is the next one to watch above that, which is also kind of where the 200 MA is sitting right now. But Solana still has a lot of work to do. I believe in the chain. I use it every day. Like I said, I perp trade on it a lot, which can be a great source for generating cash flow. I'll make another video on that specifically, but keep your eye on Solana. Might be a good buy at these levels. If it breaks down from these levels, I would definitely be a bit concerned because the next major support I don't see until like around $78, $79 down here. So it could be a big fall. And I would say that the chart would be in a lot of trouble if we break down there, but we have to look at both sides. Moving on to MicroStrategy. Again, just like Bitcoin, it showed a lot of relative strength this week. That's on the 4-hour. We'll go to the daily and make this just a little bit bigger. Again, this trend line right here is what I'm watching on MicroStrategy. Mean reversion is still in a good position. We have a long way to run, and I just want to see that trend line right there break. Pretty simple chart to watch on MicroStrategy. Just moving on to the miners quickly. So CleanSpark, like I mentioned earlier in the week, still fundamentally, they are one of the strongest miners in terms of efficiency, low cost of production. Let's just hide the VRPV. We have this very long trend line going back all the way to the bottom of the bear market here on the daily. We're testing that right now. If we break down from this trend line and the $6.40 range, I would say watch out below, and it might be time to get out of this one. But if this holds and it can bounce from here, maybe miners have one more hurrah left in them for this bull market. Again, that would require Bitcoin going on its next run, maybe hitting that 150K range. And the chart on Bitcoin actually looks positive from what we discussed earlier. But one of the most interesting miner plays to me is Marathon. Now, we still have this downtrending resistance. You're saying, Tom, why are you looking at this? This chart is just in a downward channel. Well, downward channels traditionally break to the upside eventually. But this one is a steal right now. At these prices, the Marathon NAV premium is now 0.93. That means for each share of Marathon that you're buying, you're really just buying their Bitcoin at a 7% discount, and you're getting the asset, the entire value of the company for free. The NAV premium, it can stay negative for some time, but the market is going to sniff this out and it will rebound. So watch this. If it continues dropping, you are getting a great deal on a Bitcoin proxy, again, right now at a 7% discount. And we'll see if that goes any lower with this volatility. I'm looking for a bounce in Marathon somewhere here, and we need to break this trend line. Moving on to Robinhood. Robinhood got beat up with the rest of the market. You can say, why did they get beat up? I think they just got sucked down with the rest of tech. They're not manufacturing anything overseas. Their customer base is in the US, Canada, Europe. I'm not sure whatever other markets they play in. The only logical thing I could think is that, maybe their economic concerns and retail isn't going to be investing as much. But they have all those tailwinds of the banking they're adding, their new services. Their adoption is great. They have lower fees. If you look at this chart on the daily compared to, say, let's just say Coinbase as a proxy, you can see Coinbase has dropped much more. There's been more weakness in the chart. I got out of my Coinbase position in December, and I really believe in Hood comparatively because Coinbase charges such high fees and they only have crypto assets to trade. With Hood, You have both crypto assets, you have the traditional stock market, now you have the banking services, you have all of their investment tools. And I think there is just a lot more upside. I'm going to be watching for this 200 MA to hold. Otherwise, below that, next support would be around $28 to $25, but that would be a very good value zone in my mind, that $25 to $28 right there. Let's move on to MU. And this is a trade we talked about on Monday, where it's been in a very clear range that we traded. On the daily, you can't see it, but this went back up to 108 on earnings. And it dropped down to support again. I bought down here and I set my stop loss just below at $83. And when we broke that range, I got stopped out and it has gotten absolutely smoked the last 2 days. I mean, from that little bit of a peak down, almost a 30% drop. There is a little bit of support coming in right here. You can see these other lows that we had. So I'm tempted to buy here to see what it can do, but I would say be patient and don't predict a bounce, react to a bounce, because we dropped into the middle of this volume zone. There could potentially definitely be more upside on this, but the chart is showing so much weakness that unless it shows some kind of V-shaped recovery, I would be cautious on MU moving forward. Celsius, this one has shown some of the greatest strength. I mean, even stronger than Bitcoin this week. I am really glad I made this play in a sector, like I said, that I don't normally play in, but this has been a bit of a hedge for me. Even with all the weakness in markets, it's just been testing that breakout support from this earnings high right here. And again, like I mentioned on Monday, we really want to see this $37 to like $42 range break. And then we've got a ways to run up to 52. And then I would say 60 from there. So Celsius, definitely a good one to keep your eye on. If this support holds and we can break these little ranges right here, I think we've got further to go. Okay, moving over to Deckers, still getting hammered. I really thought we were finding support in that low $100 range, but with the rest of the market and tariffs, of course, with all their overseas production, Deckers sold off. We got into 94 right here, which is support going back, I mean, years and years. And I would say this is really strong support because see how we were just up against that ceiling and then we impulsively broke out. That's a great sign of strength. And this $94 is one of the strongest areas of support, I would say, on the chart. Anywhere below that, I would be fundamentally concerned. But we bounced end of day Friday with those news of Vietnam taking off all their tariffs on the US. And Nike rallied in concert, actually rallied much more than Deckers. So Deckers was down at 94 at the start of the day. We got up to as high as 108. So let's see if this bounce continues. Maybe this could be a turnaround point for them. We are seeing volume increase. It is still crazy oversold on the daily on the RSI. Mean reversion is off the charts at minus 2.3. We've gotten buy signals right here on the Confluence model. Again, this is an Invest Answers tool, investanswers.io. Shout out. I'm going to be doing more demos on these tools down the line, but I'm keeping my eye on Deckers. I'm continuing to build my position to get my average entry cost down, and we will see what this does moving forward. Briefly looking at Palantir, this range we've been in, it just closed right below this range. So next support is down at $63. I don't have much conviction personally on Palantir. I think a lot of the run is behind it. If you're in it or looking to build a position, I would say that $62, $63 could be a good entry point. Again, anything below there and you're really breaking structure. I mean, we've set a lower high now. We're potentially going to set a lower low from Gann swing analysis, traditional charting. This chart does not look great, sorry to say. Last couple charts here, SMLR Scientific, which is also a bit of a proxy because they've been building a Bitcoin position for a while, had a fairly strong close to the week. It didn't sell off as much as the rest of the market in the tech space. This is one that I've been in for a while, building a position here, and we're back in that range. It did have this downtrending resistance that now it's been flirting with as support. I'm treading carefully with this one, and I'm continuing to build my position. But if Bitcoin runs, this one could run as well and potentially has a lot of upside. I mean, looking back at these highs from December, that was at $81. Right now we're at $33. So, you know, a 2.5x or so from here. The other one that I was playing with on the side that I didn't mention on Monday's video is SMCI, Super Microcomputer. And this one was looking good at the start of the week. We had this underside support, this downtrending resistance that was acting support, and almost at that inflection point right there. Oh, wait, no, I did mention it on Monday, didn't I? We were bouncing, but then it sold off with the rest of the market. It found a little bit of support at these lows, but I'm not loving the look of this chart right now. Like, let's see what happens with this resistance line. Can we get above it? But again, this is one that I would tread carefully with, especially if we break below this $25.50 range. Be cautious. But the chart looks weak. Keep an eye on it. Maybe there's a good entry, but be careful. Last thing I will mention, I mentioned healthcare and XLB, how I was in this as a hedge in my parents' portfolio. It just had a brutal sell-off. So you can see even sometimes the sectors that you would think are safer maybe are not. And now on the weekly, the thing I'm concerned about is like, is this a giant head and shoulders we're forming right here? If this neckline breaks, let's just draw the neckline. And all-time high, we go to there. All right. Say we break down this next week. Where would that take us? That would not be a pretty drop. $112 from 135. Again, the percentages on this aren't as extreme as other sectors, but even some of the seemingly safe plays are not looking great after these tariff announcements. Okay, that was a lot. Thank you for bearing with me. I hope you found some value in all the macro and charts we covered. Over the weekend, we're going to be looking to crypto. It's the only thing trading 24/7, and it can give us a leading edge on where broader market sentiment is at, and even a lead into how Monday's market open is going to be overnight on Sunday evening. I'm hoping for a bit of a recovery next week. If that doesn't happen and markets continue to sell off, we might have to reassess our thesis and our strategy. But I will check in with you after the market close on Monday so we can plan for the week ahead. I hope you guys all have a great weekend. I'll see you later. Bye.